Let me start off by saying that I like taking Uber and other ride sharing because it's cheaper than a taxi, especially in some other countries where it's sometimes even cheaper than public transportation. That said, liking a company does not mean the company is a good investment. So I have read a good chunk of the 420-page S1 Uber filing for their IPO, and I do not think this is a good investment at the $100 billion valuation they plan to offer stock at. The thing about stocks is that the majority of buyers will never read this S1 filing or any annual reports or quarterly reports before they decide to buy a stock. Wall Street knows this and has known this for years, and that's why they emphasize the story over the numbers. People buy stocks on emotion, and they buy stocks for the beautiful story that's pitched to them, not the numbers. In this case, the Uber story being pitched is very simple. It's, hey, all you millennials that use Uber and weren't even born when Amazon IPO'd in 1997, here's your chance to get in on the Amazon of your generation. We're not just a taxi, we're a platform of a bunch of things that can all make money in the future, like Uber Eats, scooters, bikes, Uber Freight, and somewhere in the future, autonomous cars and flying taxis. I'll explain why this story is absurd a little later. First, let's look at the numbers. Uber has taken 10 billion trips and 5 billion trips in 2018. Now, this is not only ride sharing taxi type trips, it also includes the scooters, the bikes, the Uber Eats, and even the Uber Freight. So it's not all just taxi, it's a combination of those, which makes it hard to break out. Also, 14 million trips a day, 16.5 billion miles driven in 2018. They're on 6 continents, 700 cities, 91 million users a month, and $78 billion paid to drivers. And here you see their income and their earnings. And their net income is shown in earnings before interest, taxes, depreciation, and amortization. So generally, what they're saying is they generated $50 billion in revenue, meaning in sales of the taxi, because the taxi part of it is the majority of it for now. So let's just say that it's all the taxi basically, because the other portions right now are so small in terms of revenue and earnings. So $50 billion in revenue, $10 billion in their earnings, meaning of that $50 billion in revenue, $40 billion went to the drivers, $10 billion is their gross earnings. But their loss on those earnings is $3 billion. So here's a better chart showing you the more revenue they make, the bigger their losses become. So here you see that from 2014 to 2018, they lost $12.1 billion. So yeah, if you want to compare them to Amazon and other internet bubble stocks, this is kind of like that, because at the time, all these internet stocks were losing boatloads of money on the model of selling a dollar for 80 cents. And what that means is you sell at a loss, then yeah, you're going to have a lot of revenue because a lot of people are going to be buying your product if it's cheaper than other competitors, and you're selling at a loss, you're losing 20 cents on every dollar, let's say. So at the time, companies were saying, don't even look at our earnings, look at the number of eyeballs, meaning how many people are looking at our website every day. That's a better metric. So Uber is doing the same kind of thing by saying, don't look at our earnings, only look at how many more trips we've taken this year, or how many active users we have, or how many billions of miles we've driven. The earnings will come later, we promise, kind of. So, is there a path to profits at Uber? Let's take a look at the car ride sharing and how they can become profitable. There's two ways. They can try to gain even more market share by subsidizing the losses as they do now. This is in the hope that they can drive taxis and Lyft out of business, and then they can raise prices like any monopoly would do. The other, better story is that they will have an all-autonomous fleet that will capture most of that $40 billion that they are currently paying Uber drivers a year. Looking at the first path, even Uber acknowledges that it is difficult to raise prices because of the low barrier to entry. So from their S1 here we see they say, while we intend to continue to increase our scale with a view that scale will improve margins, our offerings exist in categories with relatively low barriers to entry and low switching costs. Increased competition may prevent us from improving our margins over time or achieving profitability. Now, if they can just take 6% more of that $50 billion in revenue, they would at least break even. I'm sure the Uber drivers wouldn't mind giving up a few more dollars so Uber can stay in business and they can keep their Uber driving jobs, right? Well, the problem with that is that most Uber drivers make almost no money after you subtract the car costs involved in driving for Uber. Uber knows this and has set their rates at just enough to attract new Uber drivers, but not enough to make them stay for a long time once they figure out how little they're actually making. So there is no room to take more from Uber drivers. As a matter of fact, Uber has a lot of court cases in the past and currently about making drivers employees or making sure they at least make the minimum wage. Here you see from the RideStar survey of 2018, nearly 50% of responding drivers have been driving for Uber for under a year. Only 30% have been driving for 2 years or more. And that's why it is like this. Uber knows they have churn and they prefer it this way because once drivers figure out that they're not making money, they leave. But in the meantime, it took them some amount of months or years to realize this, and Uber's okay with that. So they just need more new sheeps to shear to come in to drive for them. And once they use them up, there's always new ones, in the wings waiting to give it their shot to see if they can make money until they realize they can't. So you see, 75% of Uber drivers provided the UberX level of service, the lowest, with an average earnings of 73 cents per mile. Okay, so their earnings are 73 cents per mile on UberX, but from Uber's S1 filing, you see they say the American Automobile Association estimates the average cost of owning and operating an automobile in the United States in 2018 at 75 cents per mile. So what does this mean? Uber drivers are losing 2 cents a mile on average? Here is Uber's own breakdown of the 75 cents per mile it costs to operate a car in the US. Now, not all Uber drivers are losing money, especially the ones in more urban areas, since they have to drive less on the way to pick up a customer. In more suburban areas, an Uber driver may have to drive a few miles to pick up their next customer. The 75-cent cost per mile is not only accruing when they're driving a customer, it is accruing for all of their driving. So this time and cost wasted on the way to a new customer is factored into their pay per hour, and that is why it is very low on average. Notice on their pie chart there are no expenses that can be eliminated by autonomous cars. They still have the same expenses and maybe even more for the extra electronics they will need and maybe even higher insurance costs. Here is a Prius New York City taxi and a Prius Uber. They have the same operating expenses. The difference in why Uber is able to sell rides cheaper is because the taxi fares must be priced high enough to attract a full-time driver, and it must also make enough to pay interest on the loan for the taxi medallion, which some got as high as 1.3 million per medallion before Uber came along. Uber is able to charge less than the taxi because there is no medallion to buy or pay loan interest on, and many drivers are part-time, so they may not realize that their pay is not enough to support them and to replace their car when it is worn out from using it for Uber. Okay, so what about when cars will drive themselves? Surely there's some money to be made then, right? Well, the cost of operating a car will not change unless they can have a car company make a car designed for autonomous driving without a driver's seat, a steering wheel that will be cheaper, smaller, weigh less, and use less fuel, or use electric cars if they're cheap enough and have enough range. But fuel is only about 15% of the operating costs anyway. So not only is there no guarantee that the autonomous cars will significantly reduce costs, Uber themselves say that it is a long way off, and even if they have autonomous cars, there will be a small percentage of Uber drivers, and it will be used in very specific cases for a long time to come. So here's some quotes from their S1. As we solve specific autonomous use cases, we will deploy autonomous vehicles against them. Such situations may include trips along a standard, well-mapped route in a predictable environment in good weather. Wow, that's really specific. Okay, and here's another quote. Accordingly, we believe that we will be uniquely suited for this dynamic during the expected long hybrid period of coexistence of drivers and autonomous vehicles. Drivers are therefore a critical and differentiating advantage for us and will continue to be our valued partners for the long term. So there you have it. Drivers are not going anyplace for a long time to come. So if Uber's not making money with drivers now, how are they going to make money later when they're still going to have these drivers? As for the story that Uber is a platform just like Amazon and therefore will have the same trajectory as Amazon, this is nonsense. Uber mentioned the word platform over 700 times in their S1 filing. They're trying to sell you the dream that Uber equals Amazon because they were both losing money when they IPO'd. Well, hundreds of companies were losing money when they IPO'd during the internet bubble with the hopes that they would gain market share and eyeballs while they lose 20 cents on every dollar of sales. The majority of these companies are not around anymore. This is called survivorship bias. You only see the companies that survived, not the hundreds that failed and lost investors billions. The Uber people know that people have a short memory. If they didn't, they would not try to compare themselves to Amazon. Why? Well, let's have a look at Amazon's spectacular ride. They started in May 1997 around a split adjusted price of $30. By January 1999, they peaked around $361. From there, they continued to fall until their bottom at $5.51 in October 2001. Yes, that is a 98.5% loss. They did not overtake their 1999 high until late 2013. Is that the stock performance that Uber is trying to emulate? So, is anybody going to get rich off of Uber? Yeah, the early private equity investors will, but only if they can sell their stock to the millions of dreamers they hope will buy Uber at a $100 billion valuation. So, if you want to do your part to help the rich get richer, place a market order on the opening day for Uber's IPO. If you would like to keep your money, wait until the smoke clears and they show a clear path to profits. That is my video on the Uber IPO. If you agree with my analysis, give me a thumbs up and subscribe. If you disagree, give me a thumbs down and leave a comment about why you think I'm wrong. Thanks for watching.